Okay, welcome back to the Consultancy Growth Podcast, everyone. I followed our guest here for some time on LinkedIn, and I would encourage you to do so. I find her insights, her experience is fantastic, but her insights, especially in these days of AI slop, her insights are fantastic, intelligent, and are clearly based on a long period of deep experience. So I've got the real pleasure of welcoming Karen Thomas Bland. Karen, welcome to the podcast.
Oh, what great to be here, Joe, and thank you for that very kind introduction about my LinkedIn.
Well, I genuinely mean it. I'm keen on evidence-based insights, and you certainly provide them. Now, you've had an interesting career and have an interesting CV. So rather than me mash it up, I was wondering if you could give us a little introduction to yourself and how you got to where you are today.
Yes, absolutely, Joe. Well, I'll work my way backwards, which is probably easier. So, for the last 15 years, I've been operating independently, and I've operated really in two tracks. So, one is private equity, non-exec, and chair roles, and they would be in the mid-market, classically B2B services and technology, but particularly consulting businesses, which is my heartland. The second track is I go into perhaps larger cap PE and the listed world and take businesses on a transformation or integration or carve out journey. So classically, they buy in another big business and want someone to come and integrate it. Or they say, we want to go on a value creation or transformation journey. We're currently here. They may have thought about where they want to go. I want someone to make that happen, or they may not have thought about where the end game is, or they're classically saying we want to carve this business out. And my clients have ranged, yeah, from private equity to listed businesses. Prior to that, I was in the US. I was in IBM, doing actually a relatively similar role, either integrating businesses, so did 10 acquisitions during that time, or I was running as the general manager those businesses. And classically, it was a combination of consultancy, data, and technology. Took me all around the world. I did a stint in Dubai in our growth markets, a stint in Brazil, doing a classic kind of turnaround. So it was one of those global roles, fantastic, built a lot of experience. Prior to that, I was in KPMG here in the UK. It had sold its consulting business off to Atos, and like all good businesses, when they sell off, they decide to rebuild that consulting practice again. So I went in very early to build out a strategy and transformation practice there. And then before that, I was in smaller consultancies. I have a very unusual background for what I ended up doing. I trained as an organizational psychologist. So
I
I spent
saw that,
6 years
yes.
doing a psychology degree and master's, 2 years of practitioner in training, and you apply and become a chartered psychologist. So that's not the usual route. Normally, people come through a business or finance background, but I did specialize in the organizational side of psychology. So the people side of a lot of change, org development, assessment, and that personality kind of discipline actually really does help you along the way as you
Sure.
navigate challenges. But yeah, that's the background in a nutshell.
And just as an aside, that psychology background. Now, I wanted to be an organizational psychologist, and I did do a little bit in that area. Did you do much quant side, or was it primarily soft stuff?
No, it's a good discipline. I'm not here to sell this to anyone listening, but it's a good discipline in both. So it's a good discipline for research, statistics, that real analysis around problems. It gives you that, and you need a good, numerical background to be able to take that on. But it also then gives you the what's often classically referred to, as you say, as that softer side, that empathy, that understanding.
Mm,
But the most important thing it gives you is how to go in and diagnose personality. So whoever you're
yes.
working with, you can build a good understanding and orientate your own style in how you might work with people. And let's be honest, Joe, the further up in an organization you go, the higher likelihood you will be to get to work with, higher conflict personalities. It's just part of the game, right? So it's good for that as well.
Yes. There was that wonderful piece of research about 20 years ago that correlated sociopathic behavior with the higher you got in the organization. And I think
Exactly.
that would be a generalization, of course, but there was some correlation there, I think.
Yeah, yeah, funny. Yeah,
Brilliant. Okay, listen, that's fantastic, Karen. So obviously, a lot of listeners to this podcast have been through that process, selling their firm and have been come out the other side, but many of them haven't, and would like to. And PE, especially these days, as you know, is a much bigger force than it was 20 years ago. So I'm interested in the difference between what you would see prior to uh, a sale to
yeah.
PE and post. So other than the cash that you've got splashing around that you can invest in different things, what are the big changes that occur either through the PE board or the board member, someone like yourself, being involved, and how should owners prepare for that? I guess.
Yeah, look, Joe, I think it's a great question. Look, I think if you're a founder, you've not got PE backing or any other finance at the moment, the biggest difference you'll find is not the cash, I say, but the clock. So as a founder, you're empowered. You make your own decisions on your own time frame. You perhaps, have a management team meeting, whatever frequency deemed to be appropriate for that. PE investment comes with much more operational discipline in the business. So prepare yourself for a monthly board, I always say. At that board in advance, you will have sent a detailed pack of information, a lot of financial
Yep.
information, getting better and putting a lot more operational and people information in. But classically, they want to know how the business has traded and how is it likely to trade over the next month. So I think that's definitely one thing. Yeah, so reporting expectations change. You are now being held to account. And for founders who've done their own thing, that is a shift to kind of make. I think decision rights is another one. So classically, my experience of founder-led consultancies, you are as one fantastic founder often who will have made ultimately the apex for all of the decisions. Suddenly, there's a board now with PE on. You've perhaps got one or two independent non-execs. You definitely have your CFO, maybe others of the management team. So suddenly, decisions are now being made in a collective, not as an individual. And for a founder, that can often feel challenging. In many ways, it feels good. I've got a broader sounding body here, but you were once used to making it on your own, and now you don't. I'd say from a people perspective, Joe, the other thing is, and I hear this often as the way the business is described, often the term we're a family is often used
Mm,
in these smaller firms. And it's great because everyone knows each other. The founder probably recruited most of them. And it feels like a kind of cozy space. Not to say performance is not there, but it tends to have a different
mm.
feel. When PE come in, it suddenly becomes about scale. So that founder
Yeah.
family now becomes scalable business. And again, that's a shift to be made. And I always say, look, I think if I think about the founders I've worked with, I would say the first 6 to 8 months is probably the most challenging because you're in that period of now operating in a different way, being accountable, having more KPIs that are being looked at. It does tend to then find its rhythm. You sort of settle in and it becomes the new normal.
Mm,
But the other thing I would say is be mindful of that flight risk. There are some people who are intuitively drawn to these very young entrepreneurial businesses and they carry with it, a lot of fun, a lot of risk, a lot of reward. Some people are not the right people for that next phase of a more formula kind of driven journey where there's more
yes.
bounds put around that. And look, I think we should always be open and honest about that with people. It's
Yes.
not you might love a certain phase a business goes in, and a scrappy startup can really appeal to someone, but that next phase of growth. So I'd say to any founders, you might not yet have the team that's going to be right for your next phase of journey.
Yes, I think that's so important. It was a major, talking of psychology, it was a major self-discovery of mine that I'm not a scale person. I love starting things up. I love growing them to, however
Yeah.
big, but Yeah, it's and that self-knowledge is important, and ideally you'll have had that prior to to so that you've got someone in place who is the right person to scale
Yeah,
it.
yeah,
Yeah, great. And you mentioned KPIs. What are the now? We will both have had experiences where you look at reporting and you think, "Oh my God, there's nothing here that I really want." But in terms of the major KPIs that perhaps founders aren't aware that they should be reporting on at
yeah.
that senior level that you would probably insist on at post transaction, what might some of those be that most founders or many founders might not be reporting on prior to the transaction?
Yeah, no, great question, Joe. Look, I think they perhaps are thinking about it, but I would really be measuring employee attrition just by what we've just said. Your
Sure.
flight risk in the first months after deal really will tell you some people will start to leave the business. And so you're really saying, how risky is this going out? So I'd say employee attrition, particularly as often there's deep-seated relationships. Client concentration. I don't think I've been through a PE due diligence where the
Mm,
client concentration measure's not looked at. Again, I'm not saying not everyone would look at this, but often we find a great customer and we do a lot of work with that customer.
mm,
It's fabulous. But PE look for, have you done that and replicated it with three other customers to show that you can, sort of scale. So I say that is another pipeline conversion. So again, perhaps you are looking at this, but how much of your actual pipeline are you good at being able to say what's hot in that pipeline and what's not, and how much of that pipeline do you actually convert? Again, PE will be very interested in that conversion percentage. Also, the length of your sales cycle. So again,
mm,
often that is not looked at in my
no.
experience. How long is the deal, potential deal, sitting there? And it tells you a lot about how quick, again, you are to convert and how long decision-making cycles might be. And I think everyone on this call who's in consulting knows that in difficult times, decisions do get delayed further and further. So one to definitely be looking at. Gross margin, I would say. So looking at gross margin by client, by service line, by geography. Utilization is always hard, but I think in consulting that does tend to get pretty well tracked.
Mm,
It might not get as tracked. So PE will look at utilization classically by band, and how is that tracking? Again, revenue per head is another one. Again, some businesses don't tend to look at it at the granular individual
yeah.
level. And then you've got your EBITDA bridge and synergy tracking. So not just current performance, but over the course of the deal, how is your EBITDA tracking? And it's always a tough one because
Yes.
clearly you don't want to be taking too much out of the business so that you haven't got a great culture. But equally, and I'd say the one, Joe, I think I find if I was saying universally across boutiques, perhaps a little bit unfairly, it is that pricing discipline. So we have a tendency, I think, to not want to charge too much. And so we price our rate per day of people at a relatively conservative, lower than sort of big players. And that holds our EBITDA right at a certain level.
Yeah.
So perhaps, that journey a business goes on from pricing per person delivering a job to on an outcome, as in what is the value this is going to do for a business. That tends
Yes.
to be a journey that businesses need to go on.
Yeah, I really like that point about pricing, I'm not sure about your experience. I have no data behind this, but as a gut feel, I would say that pricing, in terms of levers for EBITDA improvement,
Yeah,
pricing is probably the least evidenced in boutique
yeah,
firms. I don't know if you would chime with that.
100%.
And often when I talk to founders about their pricing, it will be, well, we've always priced it like this, or sometimes they'll say, well, that's what the market pays,
Yeah.
but on the basis of no evidence or a few conversations. It's interesting. Yes. Okay. Good. So, right. I'm a founder. I've gone through the process. I've been successful. I've come out the other side. Now, you and I will both have seen um, situations where PE investment has failed. And sometimes that might be something to do with what they've bought and the founders and just bad luck. The founder might leave early, or, the client concentration, they lose a couple of big clients. But then sometimes it's the PE, the issue might be with the PE themselves and how they manage it. And one of the concerns I hear from my own clients is that they're worried about the traditional reputation of PE. And perhaps that they're more used to tech and SaaS than they are to people businesses. And they're worried that the founders are going to end up, working 150 FTE themselves, and everyone's going to be under the screw. So, what? I guess there's two things. What differentiates PE approaches that work with people firms?
Yeah.
And I guess the other way of looking at that is, if you had a message to give PE firms that were moving more into the people space now, which many of them are, what advice would you give them about treating people businesses differently?
Yeah, look, Joe, I think it's a great question. And I think you hit on it right. Interest in management consulting and people-based business firms has gone wildly up. So every PE house is chasing these kind of deals. Look, I think the things to talk to them about, one is exactly what you said. A lot of the value sits within the people themselves. And so the conversations need to move away from just talking about trading updates to let's have a concentrated. So one of the things we did on one of my boards, and we also brought the HRD onto the board, is have a whole section around people and culture on your board meetings. So talk about retention, talk about
Mm.
culture, and if you've got a diagnostic, what is that telling us? Talk about succession, talk about development and training. A lot of people put a lot of store, particularly in these businesses, on how are you going to train and evolve and develop me to the next kind of roles. Talk about all of that and promotion potential. So I think make it a central part of the governance that PE understand and align on those few people metrics that really move the dial. Retention would be one, succession would be another, culture and climate would be another, so that PE are looking at a broad set of KPIs that perhaps they wouldn't necessarily orientate to. And it is a bit of a journey to get them on that. And they'll often say, well, can you go through the people bit a bit quicker? But intrinsically, you've got to remember this is where your value sits. It sits in those individuals. So I think and pre-deal, and I was actually having a conversation with a founder who's about to get PE backed last week. And I said, it's really encouraging that actually the private equity house was saying, tell me about your current culture. What are
Great.
people really valuing? People are starting to recognize that, yeah, in those businesses, we do need to ask the same questions we've always asked about EBITDA revenue, but we also need to ask about what our most valuable asset that we're buying is thinking, feeling, doing, and wants to, achieve. So look, I think it's happening, and I think PE is also switching on to the fact that they need to play a broader role in hiring. So like in one of my roles last year, PE came on to a interview process for like a senior role. So they were taking
Mm.
more interest in who is the people coming in the door. Because we both know, like, you get a hire wrong, particularly a senior hire in such a
Yeah,
small
yeah.
boutique, it actually has quite a catastrophic effect on
Mm.
culture, on profit, on, you name it. So I think they're starting to recognize those hires really matter, and if they can help and be part of that
Yeah.
decision process. Because classically, PE would just say, right, at a certain clip level, we need to approve the hiring, but that would become a binary yes, no. Whereas now I see them more coming as part of that decision making and part of meeting the individual and sussing them out. So look, I think
Great.
encouraging all of that behavior that makes them much more into that people conversation is the right one for me, and not being afraid for anyone who's chairing or being on a board out there. Put the people piece on the agenda, have your HR director ideally come and stand that up, or even be part of the board, because also I think it's part of saying as well, who do we really need in our board setting? Because classically PE was like CFO, CEO,
Yes,
that
yes.
was the mode. Whereas now, I've seen more openness to, let's put the HRD on the board, let's maybe put
Yeah, yeah.
the COO or the client director so we get some direct client feedback. That is all changing, and I think we can play a role in helping change.
Yeah, that's great. That's great. It's really good advice, and I would, push anyone who is listening to this who is thinking about scaling, whether you've got PE or not, to really think about the people side of things and having it as a standing board item on the agenda. Um, yeah, really really interesting. And just as an aside, I've recently been going through my interventions over the last 20 odd years with boards and trying to get some type of standardized methodology that I could show to other people and say, look, if you're going to be a board advisor or if you're going to be trying to increase EBITDA, these are the 50 steps that you should do
Yeah.
if you're new to. And I found it quite hard because obviously there's a lot of flexibility with different types of firms. So I guess my question to you would be, how much of your intervention is playbook?
Yeah.
Here, 20 things that I do every time, and how much of it is dependent on the firm and the people involved, I guess.
Yeah, Joe. So I see it as the 80-20 rule. So only 20% I would say is standard. The way I think about it is the 20% standard is the things you're always going to need to do. You're always going to need a board pack. You're always going to need to
Yeah,
monitor these KPIs. You're always going to need a value creation plan and a 100-day plan. And all of that is routine, mechanistic, your 20%. The 80% actually can look different per firm. You might be working on similar value creation type activities, but that element is very much tailored to that particular business. Look, I think if we're good consultants, we're not imposing this
sure.
straitjacketed approach and saying, it's follow A, B, C, D. But yes, there's a 20% that you roll out, and that is standard stuff. But no, the rest I think is really,
Yeah,
what is the journey this business is on. I mean, one business I worked on, it was all about our international expansion to the US. The last business that I exited was no international expansion in that business at all. We were all about organic growth, building out our accounts, building out our service lines, doubling down on a few sectors. It's different depending on the journey that particular business is on. And I would lean away from it has to be this thing. But I think having, like, sounds like what you're creating, which is, think about all these dimensions of your business.
yes,
That's very
yes,
useful to have, to go as a list and go, right, which one should we pick up? My other big thing is, don't try and do too many things to any founder at once. Pick
mm,
3, 4 things that you're working on at any one time and do those really well. Where value creation tends to go bad is when they say, right, there's
yes,
25
yes.
things on our list, and we're working on all of them, which tends to mean somebody's kind of got it on their radar, maybe doing something about it.
I wish I'd heard that advice 20 years ago when I started doing a board advisory work, because my approach used to be, here is the long list of things you need to do. And of course, you end up doing everything badly,
Yeah,
and
it's
losing
classic.
momentum and faith and all the rest of it. Fortunately, I've learned that lesson now.
Yeah.
Um, Karen, I was reading your CV and some of the other podcasts that you've done, and you've had a lot of success in something that is going to be very close to most founders' hearts, and that's margin and sales.
Yeah.
Um, how do you go about improving those very, very important metrics in the kind of boutique consulting firms that perhaps the listeners might be a part of?
Yeah, look, I think if we take sales, Joe, first, perhaps. So you're classically, as a founder, the person who's doing most of the sales, and you do it very well. And naturally, you were orientated to doing this work because you were fab at business development. It cannot all reside in the founder as you scale up.
Mm,
So you're looking for hires who have that potential to sell on a similar scale to you. They may also be your successor, may not. So that is one, that sales does not all kind of come together just in the founder. Who can you bring across that so that everyone plays a role? The second thing in consultancy, and this was very much IBM training, was everyone is in sales. So even if you're a
yeah,
person
great.
who's down in the delivery of the business, can you spot those opportunities? Can you ask those questions in whatever you're delivering that opens the door for other things? Doesn't mean you're the person then that has to take that forward. So I think that mantra of everyone is in sales,
Hmm.
everyone can spot opportunities is another one. And obviously, as we talked about, broaden your sales. The second thing you're probably thinking about is your service line and sector growth plan. So most businesses start singular sector, perhaps in one domain. What are those natural extensions? So if you started in FS, do you have a natural play in insurance? Is that an adjacent sector that you can go and talk about FS and it'll still be relevant and credible in that? So the second is you're thinking about how do you kind of improve your move beyond your current sectors. And the same with service lines. You might start deep in, I don't know, CRM,
Mm.
but then you might branch out into marketing transformation and others. So you look for those adjacent lines as
And
well.
and just on that, Karen, do you like to see triggers for expansion? So a couple of firms I've spoken to who've done this very successfully. For example, won't shift to another service line until they've hit EBITDA of a certain amount, and or at least gross margin and a certain growth rate, and then they'll shift. Do you look for those triggers, or is it more of a gut feel?
Yeah, look, I think so, Joe. I think you do look for triggers, but those triggers might be market driven. So it might be interest from another
Sure.
sector. It
Yep.
doesn't
Yep.
necessarily have to be we need 10 million revenue and a million of EBITDA in financial services before we move to insurance. I think often you get market triggers and signals that might take you there. It might be, an inbound inquiry. It might be that you just made your next great hire and they had a,
Mm,
capability in that. So I think triggers, yes. I think a lot of founders do have good instincts. So I wouldn't want to say this is purely like binary. They often have good
sure.
instincts around where they would play as well. The other piece to think about is your account management model. So early stage businesses have a deal mentality typically. They win a deal, they deliver that to the best possible way, they go on and that deal mentality can carry you so far. But it's the account management model that gets you into that scale. So let's say you sold a piece of work at Barclays. How do you take that one deal at Barclays and really expand that so that you're doing a much bigger footprint in that organization? And again, what a lot of founders then do is think about account leadership. So do I have someone who sits at an account level and is
Yep.
responsible for the revenue and profit in that account and everything that happens? It tends to be under a sort of growth office. We talked about pricing discipline, so won't
Hmm.
go over that too much. But I think that journey, as we talked about, from day rate pricing, time and materials to outcome based, is another journey to go on, which would often lead to good margin improvement. We also perhaps need to talk about the operational efficiency of the business. So
Hmm.
again, what I find in these smaller businesses very normally is either they've got tools that they're not using well, often the sales tools,
Yes.
or they haven't got standardized processes yet, so everything is not as efficient as perhaps it could be. The other challenge we have is whenever we hire someone in a back office role, one consulting can sometimes have a bit of tissue rejection. That's not a billable role. So how do we think about that? And it's important to get the right ones, but it's important also not to build out such a big back office
Mm,
that you've got this cost base that you've got to
yes.
maintain too early. There are certain roles you absolutely need, but it's a journey to build those out. The downside is, of course, when you hire someone senior, they want to build a team.
Yes.
Natural instinct, we all would do that. So that's just one piece to watch as well. That you've got the right roles in your back office, you've got streamlined processes, you're using the systems that you put in place, or you're replacing them for something better that would enable you to scale. But keeping that lean and cost efficient is bringing that PE discipline in.
Yes, yeah, I'm laughing because so much of this applies to me.
And
Yes,
me.
I love a tool. I love a tool, and unfortunately, I often pay for it in a way that is almost makes it invisible, the cost. And yes, I've recently decided that I've recently discovered the 99% of HubSpot's functionality I'm not using, and
Yeah.
so yeah, and they're not inexpensive. You know, they some of these tools can be quite expensive, especially once you add all the seats on.
Yeah. Yeah, no, absolutely. So yeah, just get disciplined around your back office. But I'm not advocating not to hire those roles. The time I've had conversations about should I hire a people lead? Yes, in a people-centric business, you need a people lead to support you on that journey. You also need someone who's going to own finance. And if you want to be PE backed, that role comes under a lot of pressure. So
Yes.
make sure you've got that finance lead who's bringing that discipline to the business, who'll be credible with PE and who can drive that, big, important role. So certain roles don't compromise at all.
Yes, yes, but I'm guessing that's of a certain size. So
Yeah,
I'm guessing that with the HR and the serious CFO, as
yeah.
opposed to somebody that is accounting qualified and calls themselves a CFO, I'm guessing that post transaction the CFO is obviously more important. When do you like to see a CHRO involved? Is that a typical size or a typical maturity that you get to and you think, right, now's the time? Or do you like to see that role evolve over from startup to growth to scale?
Yeah, Joe, I've seen both actually work. I've seen it where they will have an HR person in post, but it certainly won't be, a chief human resource officer.
Mm,
But they'll grow the role with the maturity of the business. Or I've seen that hire that role. So in like the last business, take that one as an example. We hired a people director post investment. So we'd got PE investment to our first PE run and we hired that role about 8 months in, having been through a serious process to get that. And we recognised that what we'd be at about 60 people at that point, so still
yep,
relatively small, but we recognised that that was an area that we really needed to dial up. We were hiring very specialist skills. We needed to make sure we'd got succession plans in place. We needed to make sure we were retaining people in what was a very hot data analytics kind of market space. So look, I think it can be both. I think you can either evolve that role as you scale, and naturally there are things to look out for of
mm,
when to hire that role. Or if you haven't had any people based in the role, or maybe you've relied on an independent firm who's maybe providing you with a bit of advice here and there. I think seriously look at it once you've got investment is probably a good trigger because yeah, all your value sits in the people. Why wouldn't you have someone
of
caretaking?
course.
It also depends on you as a founder. So I've known founders who are incredibly love that side of their job. They very much like all of the people side of things, but I've equally worked with founders who are fabulous out in the market, creating new work. And the idea of dealing with that element is just not in
Yes.
their DNA. So it's also a bit about you and where you orientate to. If your orientation is I love being out in the market. I love winning new work. Then play to that strength. That's very important. And
Yes.
not a lot of
Yes.
people do love that. So let then someone else caretake some of those operational people issues that you won't naturally feel an orientation to.
Yes, yes, I think that's a great insight, and of course, you get to a stage as a people firm where it's not just attention to people that's important; it's the competence frameworks, it's the
Yeah.
training structure or the academy, and that's obviously if you're getting on an experienced, HR director, they're going to have that. Hopefully, they'll have that in their back pocket, which will save time and all the rest of it. Um, Oh, okay. So as I said, I did. I've done a fair bit of digging. There's so much I could talk. Maybe it's another podcast, but there was something you said in. I think it was a different podcast, which was you said transform first and integrate second. And I think that, and that's I think advice post transaction. So when what do you mean by that? So is that advice for the PE firms themselves, or is it advice for the firm that's been bought?
Yeah, it's a bit of both, Joe. Look, I think I've done 51 now M&A deals, right? And
Wow,
I think
wow.
yeah, 51st was last year. I think there's a couple of things that go on. Firstly, in PE, there's obviously this speed and the clock that I talked about. So how fast can we now bring two assets together is often the question, right? And perhaps less is put on, are those independently good businesses to
Mm,
bring together? Because if you bring a
yes.
broken business into you're going to end up with a broken mess. So my approach to integration is saying, are there things within each business we need to fix first before we start to naturally bring those together? So if I take an integration I did last year, the intention was right. Let's quickly now bring all of the business units together. Let's put the back office functions together, without thinking about, okay, but one's got a broken finance system and one's got an okay finance system, but not currently big enough for the combined entity. So perhaps
Mm,
what we need to do is think about what are the processes that we want. So it's that mindset of thinking, what do we need to transform or put in place first before we suddenly rush to go, let's just bolt two things together and then it looks like we've
yeah.
integrated. And then the natural instinct, and of course, there's nothing wrong with this, it's the human nature of, right, we've brought two things to crash together, let's just quickly bring them together. But it rarely works unless it's
Yes.
thought through as a transformation. Genuinely good questions to ask is, what bits do need to be integrated? What do we perhaps need to fix first on each business before you start to think about, okay, let's bring these two assets together? Because naturally, there's processes to fix, there's procedures to fix, there's technology to fix, there's the cultural dynamic of how these are going to work together. So that's just my one take, Joe. Perhaps I
Great.
learned over the years that, yeah, don't be in such a hurry that it has to, because inevitably that probably leads you into a less good place.
Yeah, great, great. And when you do the value planning, so when the company and the board do the value planning, how do you decide? Because that long list that we talked about earlier, what I guess two things. One, what does it look like in practice? So obviously you'll have done the due diligence on the firm. So ideally the value plan will have been built, quite early on. But how do you get to those priorities? So the three or four things that you are really going to focus on that year.
I mean, you've hit, Joe, on like what I think is one of the main challenges, right? We find it hard as humans to say what are the few things we're going to do really
Mm,
well, don't we? We're
mm,
tempted to say list out all the things we want to do. I think you're right. Look, as a founder, if you've got through due diligence, and a number of areas will have been identified, expand into X service line, get an account management model, invest in one or two more industries, maybe find one international footprint, whatever it might be. There's a process to go through to say, right, what's the sequence? What's going to give us our best bang for our buck initially, and what do we maybe put further down the line? And what are the
yeah,
trigger points we would get to? You raised that already. What are the trigger points we might get to decide whether to, expand internationally or buy another company? So I think it's that. I think it's saying what's easy to do and we can do now and is very adjacent to where we start. Because remember,
hmm,
PE also brings this risk mentality that where they don't want to see 1,000 things. They just want to have what's the two or three things we're going to do first. Get them under our belt, do them really well, get them into a rhythm and cadence, and then look at the next one. So it's not about saying no to things, it's about saying what's the prioritization and sequence. Again, one skill to bring is that whole business case. So again, in the past, founders, you probably were
Yes.
like, yeah, good idea to go and invest
Yeah,
in
yeah.
Stockholm. We'll do that. And again, it came down to you. There's a discipline of bringing a business case to a board and saying, look, we really believe there's an opportunity in the US here, and this is what we think it would take. This is and do you agree? And having that discipline of doing business cases, whilst can feel tedious if you needed to write them, is good discipline because it's
Mm,
forcing you to say, what is the return? When would we get it? That kind of discipline PE likes. And so it's structuring those in a way and not just making all your bets at once. You wouldn't have the capacity anyway to absorb it. That's the other challenge, right? You can have intent, but unless you've
yes,
got the
yeah.
people who can then go and execute that. So I would say, and start small, just pick two or three things at any one time that you're really doubling down on, and the
Yes.
next can come in your next wave.
Yeah, great, great, fantastic. Okay, there's some wonderful nuggets of advice we'll hit here, some real gold. Um, I had two final questions. So one of them is, if you were going to give one piece of advice to a founder and an owner that was going into a PE transaction, what would that advice be? I realize it's going to depend on bits and pieces, but if you had a
Yeah.
hundred of them in a room and you said, look, one thing to take away from today's talk is, what would it be?
I'd say, Joe, build the discipline before PE comes, and
Right.
then it won't feel as stark a contrast. And I would say this, look, if you're a founder out there and actually you say, I don't want PE investment VC, I don't want to take, fine, but try and bring some of that discipline into the business that you
Yes,
can have
yes,
anyway. You don't need PE to have a good board pack, track the right metrics, have good decision making, bring an independent advisor on board, even forget getting PE. You can do this on your own. You can scale this
yes,
business without it. Just bring some of the great discipline that PE would bring. So I would say pre even going there, bring that discipline in place already, because then you're already operating in that mindset, and you may or may not need the cash.
yes.
So that would be my biggest one, because
That's great.
then, yeah, you're not you're
Yeah.
not you're not about to come into what feels like quite a big transition.
Yeah, it's so interesting. So I primarily deal with, sell side, or prior, a few years prior to the sale. And sometimes founders will say, I'll be chatting to them about their future plans. They'll say, well, we don't really want to sell, it's not on our radar. And I always respond, well, regardless, a good company is one that has these systems. PE and buyers, strategic buyers, want a good business. And so this is what a good business looks like. So if you want to scale by yourself, is what you should be aiming for.
Yeah, exactly.
The final thing, just a slight segue, is your LinkedIn presence. So you're very, very visible, and it's something that I really urge consultancy leaders and boutique leaders to do. And there's lots of evidence that it works, but there's still either a lot of resistance or a lot of bad examples of it happening. I
Yeah.
think you've built up a great uh, visible presence that really demonstrates your expertise, both on LinkedIn and elsewhere. What advice would you give, partners, directors, founders that wanted to develop a serious, visible presence of the type that you've built up?
Yeah. Look, I think again, Joe, my advice is probably again start small. So I would find a topic that you're really passionate about and that you're well placed to uniquely own.
Right.
Whatever that is, double down on that. Don't the worst advice is when you try and be everything to everyone, right? Your audience can be very small. If they're your buyers and there's only 10 of them, go for them, right? And I would write in the style that you're almost writing for that one person. So if you're selling to financial services, write for a financial services director in a firm that you would have as your ideal customer. Imagine that person and imagine you're writing for them, and talk about what the problem was, how you solved it, what the outcome was, very tangible impact, which consultants can often not do. Talk about the difference that you made. And don't worry if in the first post that you write, only your mum and your best friend
Yes.
like it. Please
it,
don't
it
worry.
it takes a while, doesn't it?
It does. It takes a while. And you know the good thing about that, Joe, in the beginning, you're not that good at writing like I wasn't. And
Mm.
so I didn't need much of an audience because what I was using it for was to get better at it. And
Yes.
your audience grows with how good you get at it. So
Yes.
that is absolutely fine. And I would say don't shy away from it because you can get a lot of leads through writing crisp, articulate posts. So it is a lead generation channel that's out there. There's so many people on LinkedIn as if that's the one that you choose. And just start small and build from there. And don't just make it about you, comment on other people's posts.
Mm.
Just start that journey and eventually you one day go, oh yeah, I did build that audience and it started small, but again, you don't need to be appealing to the masses here. Right for your audience, is my biggest takeaway.
Yes.
And
Brilliant.
they flock to you.
Yes, yes, it is true, and I think one of the insights from what you said there is that you don't need to dumb it down. If you look at what a viral post that hits, 20,000 people isn't that difficult to write, but it's not necessarily that useful to you. And
Yeah,
I would and we were talking before the podcast about the amount of slop that's out there.
yeah,
And I would urge people to perhaps ignore what AI says about creating a viral post that goes out to 100,000 people
yes.
and focus more on the 100 people that you really want to talk to.
Yeah, it depends on your objective, but if your
Sure.
objective is to find more leads, just talk to your audience, and your
Yeah.
audience can be quite small. And I would just to our point, whilst you might use AI to enhance your post, and that is very good instinct to do that and to do some of the research, at least in the beginning, I would make these posts yours, your
Yeah.
ideas, your flow. Enhance it by all means, but I wouldn't start by just going, hey, ChatGPT, what should I write about
Yeah.
CRM systems? I would err away from that because it's also a bit of a discipline you want to build yourself anyway, so that you do know how to bring AI in. But I
Yes.
wouldn't, my orientation wouldn't have been to start there.
Definitely. Definitely. And I think that's especially true in this age of AI because you want to be distinctive. You don't want to be the same as everyone else. And if
Yeah,
everyone else and their dog can use AI to generate posts, they're all going to be very, very similar. And so the
yeah.
more you can get your voice and your experience into it, I think the better.
I agree. But don't be shy, I always say. Like, as long as you're not writing anything controversial or that would damage, the brand of the firm, it's good discipline to be talking about
Yes.
and writing
Yeah.
about because you build ideas from others. So,
Brilliant, Karen. Thank you so much for your insights. There's so much here that I'm sure people listen to this 2 or 3 times. You've shared your wisdom freely, and we all really appreciate that. Where can people find you, Karen?
well, I think linked to our
There
conversation,
we go.
LinkedIn is the obvious place. So,
Yes,
feel free. Do please connect to me on LinkedIn. Yeah, I love to follow great people, follow your journey. So, yeah, I love to connect.
brilliant. There's a great. I would encourage everyone who can to connect with Karen. Her insights are fantastic. Karen, thank you so much for your time.
Brilliant. My pleasure, Joe. Wonderful to be here. Thank you so much.
Take care.